Hey everybody, welcome back to Things You Should Know Accounting Edition. And today will be the day of covering revenue transactions. I realize these transactions are repeats of original transactions, but T accounts are slightly different and are a much more practical way to record transactions. We can never go over the basics too much. Remember, equity accounts are more than just owner's equity. All revenue and expense transactions are also considered equity accounts. Before we go any further, we'll cover the rules of debit and credit. Now, the rules of debit and credit, the term debit is used for an entry on the left side of any T account, and the term credit is used for the right side of the T account. The important thing to remember about all this, guys, debit and credit do not mean increase and decrease. This tripped me up a lot in school when I was learning this the first time. Debit and credit purely mean left side of the T account and for the debit, and the right side of the T account for the credit. Now, the first transaction we're going to be handling today is the standard revenue transactions that Jello receives over the course of the month. Jello had two types of revenue. He had normal coffee sales from his shop, and he had fundraiser revenue that he earned from the Boys and Girls Club fundraiser. So if you notice, the first type of revenue, for the January revenue, Jello earned $40,000 for normal coffee sales. He earned $10,000 for the Boys and Girls Club fundraiser. These are going to be handled separately. For the $40,000 normal sales, you would normally increase the cash by $40,000, so it would be on the left-hand side. See how they kind of match up? And then you'd have the offsetting right-hand account would be the revenue equity. In this case, we're going to say it's coffee revenue, just Jello's basic coffee revenue, $40,000. The second asset, a little different. The second transaction is a little different. Jello did not get payment for that $10,000. Instead, the Boys and Girls Club, they're kind of getting by. They're not doing very well, and they asked if they could pay at the end of the month. Jello, being the great guy he is, said go ahead. Jello will first of all separate the different types of revenues into buckets. You do this so at the end of the month and at the end of the year when you look at the reports, you can see what areas of your business are doing better or worse. In this case, Jello started up a new revenue, fundraiser revenue. It's a new equity account. He records an increase in the revenue of $10,000. That matches up to the K. Now, since he did not get paid, he doesn't have cash to increase. So instead, he starts another asset account. This time we'll call it fundraiser accounts receivable. He'll record an asset of $10,000 of what is owed to him. The $10,000 is accounts receivable owed by the Boys and Girls Club. So that's how you get the offset. You have $10,000 increased asset fundraiser accounts receivable will be offset by the increased revenue, $10,000 on the right-hand side of the T account for fundraiser revenue. So pretty straightforward. Those two types of revenues will equal these two types of accounts being raised. Cash, increase cash by $40,000, increase coffee revenue by $40,000. For the $10,000 credit that for the $10,000 accounts receivable, you put that on the left side, J to J, and you'll offset it with the fundraiser revenue, $10,000 K to K. Now our second transaction will be the Boys and Girls Club actually paying cash, paying off what they owe. So for this, the Jello Coffee Shop was paid $10,000 by the Boys and Girls Club for the outstanding accounts receivable. For the analysis, the asset account in this transaction is cash. We'll increase it by $10,000 on the left-hand side, and then you'll record the credit, and that's the debit. You'd always debit cash to increase it. It's the left-hand side. The offsetting account is not a revenue, not an equity, not a liability. You're reducing the amount of accounts receivable owed by them. So you'll see here that M on the right-hand side represents a decrease in a revenue. So you have the right to the right, $10,000 offsets the $10,000 cash. It means the accounts receivable will net out to zero when you take $10,000, subtract $10,000 equals zero, and that's as it should be. No one owes Jello any more money. And then you add the $10,000 to cash. Well, that is how you're going to handle revenue transactions using T accounts. Very similar to what we covered earlier, but by using T accounts, it'll make it easier for Jello to track how his business is doing. Now, I'm going to go quickly back to the overall general account. This is the general ledger. See, we had all the old stuff from last week. We had everything here, cash, equipment, supplies, short-term loan, and Jello's capital. This week, we added two more cash entries to represent more cash, more money that Jello's making. We also added the accounts receivable as a different type of asset. It's also in the same setup. we had where we'd increased the accounts receivable because of what the Boys and Girls Club owed, and then when they reduced it by paying us cash, which would be offset by this $10,000. You'll also notice two revenue accounts, the coffee revenue, where we increased coffee revenue by $40,000. On the right-hand side, that's a credit. For the fundraiser revenue, we also earned another $10,000, another increase, which, as it says here, you record the increases on the right side of equity, and that's where the $10,000 go. And once again, you'll notice this $10,000, when they earned in accounts receivable, was offset by the revenue earned. This cash, indicating how much revenue we made in normal coffee sales, was offset by the cash that went directly into the bank. Join us next week when we do our final T account only video dealing with expense transactions and T accounts and how they affect the trial balance. After that, we'll expand our look at accounting by utilizing T accounts to be a regular part of a more in-depth look at accounting and how it's done. Until then, take care.